The mic is on. So price simulation models. What are we talking here? Let's be very clear. We're not forecasting price. That's impossible. No one can focus price. So I do a lot of media, and invariably some anchors get it, some don't. But there was, Stephen, where's oil prices going? I don't know. You don't know. You don't. No one knows. BP doesn't know. OPEC doesn't know. They don't know because why? They're clients of mine. And so we work to get a range of the possibility of where price could go, not where it's going, because price is a random event. So, movie, Wall Street from the late 1980s, Greed is Good. Now, there was a book written, Mathematician Plays the Stock Market. He quipped, and I'm totally stealing this from him, that what Gordon Gekko was really saying was not that greed was good, but E is good, as in the base of the natural logarithm, which is a constant function, which is part of the formula of P, price, times a constant variable, raised to R, an expected return, multiplied by time. That is the formula broken down into compounding interest. So that is the bedrock of modern financial theory. So today's price is nothing but yesterday's price multiplied by a constant raised to an expected rate of return. So it's very easy to forecast today's price for crude oil. Crude oil yesterday settled, I don't know, what did it settle at? Just pick a number, $55.96. I can tell you exactly what today's settle is going to be if you can tell me what R is going to be. Okay, so this problem is it's not. So what are we doing here? So we have to make assumptions. So part of the assumption, oh, there we go, I'm used to, okay, elasticity. Now, we're going to look at elasticity not the way an economist would look at elasticity. Elasticity of demand, supply, so forth, markets' behavior and how they react to certain prices. We're going to look at more from the way that an engineer would look at elasticity. So elasticity, I don't need to read it, but essentially how does you take a body that has compression or an extraction under a given amount of force, how does it react? And once that force is removed, how does it regress? So an engineer and metallurgist would look at the atomic lattice of the material, the characteristics of what he's trying to measure. A chemical engineer would look at this rubber band, and they can measure and tell you exactly what the elasticity is if they knew what the polymer chain is. So they can tell you exactly how much force I could put on this band before it breaks and how much force it requires to pull it back. And so this is what we're doing here. A financial engineer is going to look at the elasticity of price, the variance. How far, you have a median price, how low can it go before it regresses back to that median? How high does it go? So when a drone strike knocks out 5% of the world's oil in a single day, and oil prices go like this, okay? Now, one or two things are going to happen. It's not going to stay here because it's not there for any good fundamental reason, all right? Everything that has been known, if you believe in the efficient pricing model, is that all the information that was keeping oil in between $50 and $60 a barrel had been priced in. You introduce this new force, what's going to happen? I'm either going to continue to pull this apart, and this rubber band's going to snap, and I'm not going to do it because I did it once in a presentation, and it hurt. Like they slapped and pinched my hands. It really, really hurts. So I'm not going to do that. But as you can imagine, if this rubber band breaks, all that force, I'm going to get that reaction. And that's exactly what happened in the drone strike. Now, fundamentally speaking, if this happened 10 years ago, when the United States was producing 4 million barrels of oil as opposed to 13 million barrels of oil today, when we did not have electric hybrids on the market, when from an economist standpoint, the elasticity of demand were much different 10 years ago than they were today. If you had that event happen 10 years ago, we would have gone to 70, then to 80, then to 90, and then who knows? Here we had a very orderly knee-jerk reaction, and that knee-jerk reaction was simply because people who were short on the Friday afternoon panicked at 6 o'clock Sunday night when the market opened and bought everything back, and you had that reaction. So what we have to do is we're going to make assumptions based on how we're going to measure the market's elasticity. Okay, so the assumptions are going to be there's a drift component. So Hooke's law, right, is human behavior. All right, well, we're going to adopt it for human behavior. Hooke's law says that the amount of compression and extraction I'm putting on this rubber band is going to be proportional. All right. Now, if this was, I'm measuring the elasticity of rubber, yes, it's going to be the amount of elasticity that I pull my hands apart going to be proportional to what's pulling those hands back together. But this is pricing. This is human behavior. We buy and sell for different reasons. Well, honestly, we only buy for one reason. We think there's going to be appreciation. We sell for many different reasons. So that's the one assumption, that it's going to be proportional. And then we have to appreciate that this proportion, to measure that proportion of how the market overreacts or underreacts to an event, and how that tells you the underlying fundamentals have changed. You have the random walk theory. Prices could go. If I'm telling you that the market, here's the market's mean, this is the range, and tomorrow, next week, next month, this season, whatever, this is the proportion of the 1 standard deviation, 2 standard deviations of our expected model's return. All I'm telling you is how wide the market could go. I'm not telling you it's going to only go to the right of the axis or to the left of the axis. So every day is an absolute random walk. So what we have to do is model that randomness. And we're going to model a market's randomness by Brownian motion. Now, Brownian motion was a mathematical formula that was adopted in the world of physics about 100 years ago. It was meant to model the random behavior of molecules under perfect lab tests. So in the 1960s, 2 economists from the University of Chicago, Fisher Black and Myron Scholes, you know, you've heard about options, the Black-Scholes models. These 2 guys won a Nobel in economics by adopting Brownian motion to price options. Options are nothing but insurance policies. I buy insurance, health insurance, car insurance, I'm doing it. The company is selling me insurance on the assumption they're taking a calculated risk, they're not going to have to pay out. They're not going to have to pay out, and they're going to make their living off of the premiums. This is what an options trader is going to do, is they're going to live off of the premiums. And the only way you can do that is model the events. Now, there was an event last November in the natural gas market by a guy who ran a hedge fund and wrote a book called Option Seller. Okay, the Option Seller Bible, optionseller.com. Here's a man who clearly knew something about options. He did not know how to price risk into the options. He did not know how to measure the elasticity of natural gas. This is where he made his fatal mistake. More importantly, the fatal mistake for all the clients' money he lost was that he clearly, in my estimate, was only looking at natural gas over the last 4 or 5 years. Natural gas is in a perpetual bear market. It will be for the foreseeable future. Eventually, it's going to be one heck of a bull market, but we're still years and years away from that. So he was only looking at natural gas in this range over 5, 6, 7 years. And if you looked at that time period, he was correct. The market could never do this. So that's telling me he never traded options, or he never traded natural gas in 2008 when Hurricane Gus pushed natural gas prices from $5 to $15. He didn't trade natural gas during Hurricane Katrina when natural gas prices went from $10 to $15, or when Enron imploded and natural gas prices went from $2 to $10. He's been looking at a perpetual bear market where natural gas goes to $4, it comes back to $2.50, goes back up to $4, comes back to $2.50. He never thought this could happen, and he risked all his clients' money on this event never occurring because he did not measure the assumption of taking human behavior into effect with Hooke's law. And then there's the central limit theorem. So the central limit theorem is we're going to go off the empirical rule that I'm going to run a model of potential price distributions 1,000, 10,000, 100,000 times. 68% of my returns are going to fall within 1 standard deviation, 2 standard deviations, so forth. So we have to make the assumptions, and we have to trust the process. So the drift component. This is the normal buying and selling. Like, I got a kid's bar mitzvah coming up. I'm going to sell part of my portfolio to pay for the reception. I'm selling. Not a rational reason to sell if I really think that stock has further appreciation, but I'm selling because maybe, perhaps, in that particular situation, I need the money. So it's that constant yin and yang over time. So what we do is identify the drift components, to identify the periodic returns adjusted for time to give us an idea of how the market has demonstrated just how far I can stretch this rubber band before it regresses or before it breaks. And then there's the random component. And this is where Brownian motion comes in. This is the drone strike. This is an unexpected hurricane. Remember Hurricane Katrina? I was trading natural gas. Fortunately, I had a position on, better to be lucky than good, where we were long, and we were long natural gas. And when I went home on Friday afternoon, every model, computer model, and by the way, the computer models that track the hurricanes, which way? That's what we're doing here. It's all probability-based. You're feeding variables into the likely path, and that's what they're doing. They're not telling you exactly where the hurricane's going, because on Friday afternoon, do you know where that hurricane was going? Hurricane Katrina was going into Tampa. It was going to cross the state of Florida. It was going to hook nose and go right back into Florida. Then Saturday morning, they moved it over to Tallahassee, Panama City. I woke up Sunday morning, boom, the Sabine Pass, New Orleans, the heart of the oil and gas industry. So that is the random component, and that is the volatility shock, and that is something the option seller guy did not do. He did not accurately forecast volatility shocks. But you take these two components together, and voila, you have tomorrow's theoretical price. Okay, theoretical price. Okay, that's one price. So as we said, on the Hooke's law, Brownian motion, central limit theorem, the empirical rule, where if I run a potential, what is tomorrow's price going to be based on my estimate of volatility, which is nothing more than my measurement of the characteristics of this rubber band, then all the assumptions that I'm making, 68% of that data is going to fall within one standard deviation, 95% within two, and then 99.7, so 370 out of 371 events, my model is going to capture the events under that distribution. That's the big assumption that we're making here, that the returns are normally distributed. So let's run through a real-life example. Exactly. So, and that's why we have, and the measure is going to be the kurtosis and the skew of just how far out we can go and how close we are, we're getting into the limit calculus here, how far to the x-axis. We're never going to quite touch it, but so sometimes you're going to have a very wide, right, distribution, all right, so very loud outcomes, and sometimes it's going to be very, it's going to be very narrow, but it's meant to capture both bullish exogenous events and bearish events. And so this isn't a price prediction as far as bias in direction. This is to identify when is the market, perhaps we have plenty of hedging clients and plenty of traders that they're all in the market for different reasons and have different price horizons and attitudes towards their risk portfolio. So real world example. Okay, that's a black squiggly line. Those are settlement prices for the Houston zone. So the area of Houston in Texas for power prices. And I've done this. This is an example I use for a client who obviously is a big producer and consumer in southern Texas. So Q1 of 2019, this is the forecast we were making. So this is the forward market for the first quarter 2019 market, and this was back in January 17th. So that was the first quarter pricing, okay? We peaked at around $30 per megawatt hour. We troughed somewhere around $27 per megawatt hour. So again, looking at the characteristics of the Houston market, the gas market, the power market, the weather, the seasonality, the growth of manufacturing, so forth. We take these in an event, and then we model, okay, how are we going to draw our rubber bands? And then we're going to feed it in, and we're going to make an assumption. And we're going to make the assumption. Okay, so that orange line is one potential price path. I'm not saying that I'm bullish Q1 Houston zone power, because there is, if you take the linear of that, there is a upward skew to that market. That's only one potential price path. So I'm going to run the model a second time and get another potential price path. I'm going to do it again, and then again, and again, and again. I think you get the point. I'm going to run it standard industry practice. I'm going to run it 10,000 events. Those are 10,000 potential price paths. Once again, it's not a price forecast, it's a potential price path. So when we take our distribution and we invert it to get an idea, kind of looks like a bell curve. So when we are getting out to the outer ends, so if I've got a client who's a producer of natural gas, all right, whenever we're getting to, step across the screen here, right, I want him hedging as much forward output as he can at these prices. Because at some point, we're making the bet over time, we're going to, right here, the rubber band's all the way here. At some point, I expect that rubber band to regress. Why buy it, sell your power forward at one standard deviation when I could do it of an expected return? Conversely, with our manufacturing and our power buyers, fixed buyers of the market, right now, power prices are here. I don't know if you've been to Texas recently, but it's hot. Shocker. August, September, it's hot in Texas. But the problem was in Texas, and we have a major client there who, in June and July, power prices, guess what? They were down here. Okay? Because, yeah, it's supposed to be hot in Texas in June, July, and it was, but not by their standards. And so you could have been buying, and I was imploring Josh, Dawn, in our office with our clients, screaming at them, calling them names for not hedging, because they thought they were going to buy. If I could, I'd rather buy power at $20, $25 a megawatt hour, but I'd really want to buy it at $20. Well, I tell you what, you're risking that pot odds. You're risking an extra $5. What you're doing is you're risking $40 to the upside to potentially win maybe a couple more dollars. Dumb. Because guess what happened? In August, it got hot and it stayed hot. So now power prices are, they're not here, they're not here. They're all the way up in the third standard deviation right now. So they missed an absolute golden opportunity because they thought, and what happens? Behavioral finance. We fall in love. We don't think prices could go. I'll give you another anecdote. A major natural gas buyer. Natural gas prices, $2.04 back in August 8th, I think. Okay, $2 natural gas is barrel oil equivalent of roughly $18 a barrel oil. Pretty cheap energy. Called them up, saying, "You hedging? Let's go. Let's get it on." And I'm not getting compensated. I'm not selling a hedging product, a class, so I'm not making money out of it. I'm saying my success is contingent upon his success. I want him buying gas at good value because I want him to stay in business because I want to keep him as a client. So that's my vested interest with him hedging. Not that I'm making money off of the hedge, because I have gotten that question before. So his response was, "I'm waiting to buy gas below $2. What is so magical? Why is gas at $2.04 such a bad buy, but gas at $1.99 is such a great buy? Okay. He did it because it's all psychology. Now, when I traded down in the NYMEX in the crude oil pit, the offer for oil at the time was $99. It was at $99.75. Okay. Had never traded $100 ever before. The bid was $99.50. It was a wide bid because there was a lot of volatility. The offer was $99.75. All of a sudden, boom, oil trades $100 a barrel. And why did it trade $100 a barrel? Because the guy who bought it wanted to say, "I'm the first person to buy $100 oil." And now the CFTC had to step in, the NYMEX had to step in, because you can't buy something that's higher than the highest offer price. But he wanted to do it not for any other reason other than he wanted to be the first one to do it. This guy wanted to be the first one to buy $2. Yes. Yes. The other side of the hedge, he's a buyer for a major big box retailer. So they have a tremendous amount of power. Imagine to keep the lights on in a hotel, or in their distribution. So they are major power consumers. So, for natural gas, it was, and they run a production facility as well that consumes a lot of natural gas. So they are natural buyers in the market. It would have been a massive hedge. And so all I can do is kind of just show them the potential of what could happen. But he had no other reason. And why my hedging clients like me, because if I go ahead and they go ahead and lock gas in for the next 3 years, and let's say something happens and the rubber band snaps, and all of a sudden gas, okay, they go back to the board and saying, look, this was statistically, mathematically, this was the right decision at the time. Okay. They still have, but mathematically, they made the correct decision. Now, when he goes back to his board, because guess what? Natural gas prices are considerably higher than $2.04. Now to say, well, how come you didn't buy in August? I mean, he'll make up a story. He'll blame Schork, but he can't say, oh, I was waiting to buy $1.99. But he wanted to do it because it was just nothing but a psychological number. And this is what happens when oil prices. Oh, oil is going to. You always hear it when it gets to $50 a barrel. Oh, that's the magic number. Well, no, it's not, because the marginal cost of production is for the big producers, it's $38 a barrel. So there's nothing magical about oil staying above $50, other than the fact that it's a big, easy to divide number. Everyone can divide 50 by 10. You can't, nobody can do by 40, 47 by 3. But so it's a very easy number to digest. So when it's nothing but a cycle, there's nothing difference between oil at $50.01 and $49.99, other than the fact that one has a 5 handle, the other one has a 4 handle. So, okay. So real world again. So we're going to go probability density function. So what we're doing here, okay, is taking that bell curve here and we're turning it, oops, like this. So now this is the distribution function. This is the model for natural gas prices for the winter strip. We'll run through the example for my clients. So number of observations in the y-axis, potential price paths from $0 out to $6 a decatherm, so from $0 to barrel oil equivalent out to $36 a barrel oil equivalent, with a median of about $2.50. So when we did the presentation for the client, okay, I kept, because there's a very tight range within that one standard deviation. Natural gas market is a very volatile market, as the option seller clients can tell you. So we only hedged here or explained the 3 standard deviations. I'm telling him to buy here. I'm telling him to stay away when we're up there. So wherever we're to the left of the median here, and the further left we go, that's the further this rubber band is going to be stretched. Now, the good thing about saying buy in $1.50 gas, even if this was a trade, the good thing about that is, guess what? I know exactly how much I can lose. $1.50. Can't go below 0, right? So the further we get by here, the more I love owning, given the market. On the other side, when we get further on out to the right of the axis, infinite. We can go to $6, $7, $8, $9. So this is why I don't mind selling puts, naked puts, because once again, if I'm selling a put, my exposure is from wherever my strike price is down to 0. But if I'm selling a naked call, okay, call price can go. So I'm sorry, any questions? Okay, so that said, here's the example we ran through. So we can take this, that's the model. And then when we kind of overlay the model to the actual price path. Okay, December gas and these are quarterly, and this was for gas. So if I'm U.S. Steel, U.S. Gypsum, I consume a lot of natural gas. If I wanted to lock in my natural gas exposure, okay, for this winter, at the start of last winter, I could have locked in gas at $3. We finished last winter at $3.03, so we were in a very tight. This band was really, really, really tight. Okay. Then, of course, the winter ended. Natural gas is a winter demand. It's one of its peak seasons, that and the summer cooling season. So natural gas prices began to tank right at the end of the winter. But notice how they started to tank. Those bows, those flowers right there, those are the distributions. That's the one standard deviation distribution. And we had a very nice, followed all the way down until we got to that first level of support. And so when we came out for June, we came out with our new summer forecast, the new probability distribution functions of the potential of how high we can go. So the first standard deviation, volatility-based cone, measurement of elasticity, was looking at the first high price was $2.65 and $2.21. Notice how low the high price is relative to how low the bottom price is. Much greater risk for downside risk. Now, a lot of this is a function of we were in a well-defined market, so you had greater volatility potential to the downside, which is what we were advising. So if you're trading, plenty of peaks and troughs to trade. If you're hedging, dollar cost averaging, you should have been buying in all along. Or from an investment standpoint, and this obviously these models are applicable to anything to identify the opportunity. Okay, so here we are again. We continued the trend, and once again, this was the original model. Okay, and now again, once again, we're following that trend again, that arc down. So $3, $2.57, $2.40 back in August. Okay. Okay, August, you're thinking natural gas. The demand season is, the demand season is one of the peak demand seasons is air conditioning demand. Okay, we're at the end of August, air conditioning season's over. We've had a tremendous rebuild. The fundamentals in natural gas, there's a lot of storage out there. Industrial demand is weaker. Manufacturing demand is much weaker this summer as opposed to last summer. So all these signs are aligning for that continuation to keep on going. So when I talked to the client, this was for the winter strip, and what he was buying was the outright month, which was down to $2.04. No, I want to buy lower. And his thinking is not incorrect. It's intuitive. But the problem is he's making the assumption that his intuition is going to pay off. But if it's so intuitive, then guess what? Everybody in this room has the same. We all know it's the end of the summer. We all know manufacturing demand has pulled back. We all know, if you're paying attention, how bearish the situation with the supply rebuilds are. We all know it. So guess what? If we all know it, it's all priced in. So just because it makes sense that if gas is at $2.05 in August when demand's at its highest, boy, wait till we get till the end of September, the middle of October. No one's got their air conditionings on anymore. And it's too early for gas furnace demand. Boy, we're going to go down. I mean, we're going to go to zero, okay? So that's the thinking. But of course, when you get groupthink, the market tends to go the other way. And you rebound. And you rebound because what happens? What we do know is that Wall Street had never been more bearish natural gas ever. So 75% Wall Street is is bullish natural gas, 75% of the time. They own more long contracts than they've shorted the contracts. Back at the beginning of the summer, they caught on and they reversed. So all summer long, they were net short. Now that only happens 25% of the time. And the problem is that volatility wasn't here for the natural gas market. Volatility was all the way out here. So when you marry the volatility of how wide prices can go high, low, you marry that to an all-time net long contract position, Wall Street was never taking a more bearish bet on natural gas ever. And it worked, and it worked, and it worked until it didn't. So now I'll tell you right now, natural gas prices are free to start falling. Because what's happened? Wall Street no longer has that position. So you've taken all that buying was more a function of liquidation of shorts, not that you had new buyers coming into the market, because open interest is falling. Open interest is a measurement of the amount of dollars coming in. Yes, sir.
So, if I understand you correctly, like for example, December, or is that 26th of December time frame?
Right here.
So you have one set of parameters or one set of volatility parameters.
Yes.
So you have your 1, 2, 3 at around 26th, and the 26th March happens, and then you reset the parameters for each outside of the presentation on the far right.
Yeah, so I have this one here just to show you, just to like kind of back test it to show you. So this is where we were. So we came in at the end of March, at the end of the winter, going forward. So this was the model going forward through the spring. Okay. So I adjust it usually either every meteorological season, summer, winter, or quarter. Yes.
And then my question was going to be, set your parameters don't say you can't say it's going to go up or down. It's based off of fundamentals.
Exactly. Yeah, and that's what the 4 o'clock talk is going to be, because it's marrying the fundamentals. Because the way I started this was for my own job survival. I used to be a floor trader. Oh yeah, there. Oh yeah, so there is a in the daily report, which there are copies. I believe you passed it over. We definitely have a bias, and the bias is based on fundamentals and technicals. And I tell you what, if where I'll really get excited is if I'm really, I am bearish natural gas. You can't help not be bearish fundamentally. I mean, there's just too much out. We're producing too much. My great state of Pennsylvania, I love. We are just producing way too much natural gas here. We don't have enough pipelines to get it out. So you have a glut. And the same in Eastern Ohio and West Virginia and so forth. So I do not like buying natural gas up here, but I do, now that we're up here, I'm more inclined to sell gas up here, okay? Because now I know we're starting to stretch it, and when you can marry your technical quantitative bias or your parameters of elasticity with a fundamental story, and that's something to really get excited about. I know we started late, but I want to keep you guys on time. I only have a few more minutes. Yeah, I'm sorry, do you have a question, sir? Yeah, of course. Mm-hmm.
So you're assuming that.
No, I think part of it was short covering, yes.
When I heard that, I said, wow, this could be a huge event.
Yeah, it was a huge event.
Plus the possibility of other drones.
Yeah.
Why didn't it go
Yeah, it's an excellent point, because when you think about it, anecdotally, and the question was about the drone attack and the lack of ability to follow through is, and if you were at my keynote, I briefly spoke about this, that when we look from an economist standpoint at the elasticities of demand, okay, 10 years ago it was a much different picture, right? So we were producing a fraction of the crude oil here in the United States, 4 or 5 million barrels. We're producing 13 million barrels a day. I personally own an electric hybrid vehicle, plug-in hybrid. I burn gas, but I also burn power. So I used to get in my old SUV, big Lexus, the Land Cruiser, like a Sherman tank. That thing got 13 miles to the gallon. Today I get 55 miles to the gallon. I'm
It's not the factor that.
not one bit. So what kind of is blowing my mind in the oil markets is how many people have poo-pooed. Like I kept on hearing, but China is growing, India is growing. Yeah, they're growing, but those are just more markets for EVs. Now granted, I would not have bought mine if it wasn't for the tax incentive. I mean that was artificially but now I'm hooked. So I don't see any reason ever to go back. So they've lost. So where I used to fill up my SUV 6 times every 6 days, I fill it up now maybe every 66 days. That is oil demand that is never coming back.
So that goes, that's political.
Yeah, look, I think that opens up, it's an excellent question, because that opens up a pretty scary, and this is what we've been talking about in the report for the past 5 years. It is, everyone was so happy, the United States is producing, we're going to stick it to the Russians, we're going to stick it to the Arabs, we're going to stick it to the Venezuelans. This is great, this is great, this is great. Okay, how does Venezuela make its money? One way, How does Saudi Arabia, Iraq, Iran make their money? One way. The Russians, one way. What happens when you take their income away? Well, you're going to see, you think things are volatile now around the world? It's only going to get uglier. And you're going to start to see alliances. And this is, again, so to your point, and I'm going to wrap it up, and then I'll take more questions because I know we're out of time. I just want to, so this is the Brent market. This is the more of the global market, and I ran through this example. And this is the first telltale that something is fundamental. So why you want to look at the market quantitatively is that this is an expectation. When the market doesn't behave mathematically the way it has demonstrated its ability to act before, that's your first telltale that the tectonic plates have shifted somehow. Something's changed on the fundamentals. That's your first telltale. So that's why you don't become married based on the fundamentals. So this was the Friday before the drone strike. So the Brent market, November, over the price of Brent for delivery in the month of December. November was trading at 97-cent premium to the December contract. Makes sense. The refineries in Northern Europe are coming out of their maintenance season. The refineries here in the United States are coming out of their maintenance season. They're going to really start to burn oil in the month of November. So it makes sense that the November oil is more dear relative to December. And of course, on Monday, $1.34. Now, that was panic. That was, oh my God, I'm short. We've just blew up Saudi Arabia. My God, oil's going to go to $200 a barrel. You're going to get speculators, yahoos are going to jump in thinking, no, I'm going to buy this headline. Never buy a headline. Never sell a headline. And we got to $1.34. Now, you would expect, and I did this before. Okay, that was WTI. So the same thing. The Friday before, 21 cents, 64 cents on Monday. Here we were yesterday, 14 cents. So we're right back to where we are. No impact. So that's telling us the fundamentals in this market have completely changed. Now, they've changed because now the United States is producing too much crude oil as we are producing too much gas. It's a little different in the Brent market because we went, again, all standard deviations expected return, $1.97 to $1.34. Okay, we're down to $1.98. Okay, so final two graphs. This is the difference between the Brent market on the ICE and the NYMEX market. So Brent trades at a premium to WTI, $5.42 on September 13th, $6.35 after. So we had, and that makes sense. Brent is more indexed towards the global price. We're a bit inoculated here because of all our production. So Brent is more sensitive to geopolitical headlines. That does make sense. And this is where the spread was yesterday, $6.18. People, that's your risk premium. Okay. So that is what's being priced in right now. So Brent is now more. Brent is now outsized. So we've got about $1 risk has now been priced into the market. So when people said, and I've gotten this question, I haven't had to field this question in the media for 10 years since the Great Recession. And then since the Great Recession and the shale gale began here in the United States, and I used to go to Vienna for OPEC meetings. Now I got to go to Pittsburgh and Cleveland. So I've never had to deal with the risk premium question before. It's coming back into the fore because this is a real event, but it doesn't have the staying power because we are think about it. Our kids, I'll never get into a driverless car, and I don't think Elon Musk will ever make one that can safely be driven, but someone will, and we are wrapping up right now. But my children, I've got a 22 and 19 and 16-year-old. Conceivably, they'll never own a gas-only powered car. And then when we look at the way the demographics have shifted, we're down to 2 cars in my house. Eventually, we'll be down to 1 car. 5 years ago, we had 3 cars. The theory now outgoing is, in another generation, no one's ever going to own cars again. If I can go up with driverless Uber, why pay in finance insurance for something that's going to sit in the driveway 23 out of every 24 hours? Conceivably doesn't make any sense. But now we have something to do about it, and that all impacts. And it does mark the long-term death of oil, which is just, I can't believe I'm up here saying that. 5 years ago, I would be like, oh, no way. It's happening. It's happening a lot faster than anyone has really realized. So, anything else, guys? Oh, and then, yes, so we'll have the 4 o'clock, so we'll be a bit more, I'll drone on, no pun intended, more about kind of the models here and how to kind of marry it with and how the fundamentals have shifted. So, Any other questions? I appreciate the opportunity. Thanks, guys. Of course, no, yeah, please, no. If you have questions, people have questions also, so.
Every Wednesday, we did a gasoline storage report.